Forsure Eng Limited is a company that prides itself in the fact that their products are 100% in the best interest of their clients and at all time ensuring excellent client service. FNS has a 31 July financial year end. FNS had quite a number of complicated fixed asset transactions during the current financial year, as well as share issue and share conversion transactions. At the beginning of the current financial year, the financial manager of almost 12 years resigned. A new financial minister, Mr. D. Fickold, who graduated in 2017, was appointed but unfortunately did not yet have experience in the complex nature of transactions that took place this year. In order to adhere to the requirements of IFRS, FNS made a decision to outsource the preparation of the annual financial statements for the year ended 31 July 2018 to BBC accountants. And provided that Mr. Difficult is 100% involved. As you are a responsible accountant of BBC Accountants, the following information was provided for the preparation of annual financial statements. And then I give you an extract of balances as at 31 July 2018 and 2017. Land and building, equipment at cost, accumulated depreciation, delivery vehicles, accumulated depreciation, investment in listed entities, accrued income, shareholders for dividends, SARS dividend withholding tax, SARS income tax, bank, ordinary share capital, preference share capital, 5%, 6% convertible pref share capital, revaluation reserve, retained earnings, and preliminary profit before tax, and a lot of question marks in between. Then they give us additional information. And they require, number one, prepare the property, plant and equipment note according to IAS 16, property, plant and equipment as it relates to the financial statements of Forsure for the year ended 31 July 2018. And then the B part, prepare only the equity and non-current liability sections to the statement of financial position as at 31 July 2018. So by implication, they don't tell you that, but you have to do the statement of changes in equity, otherwise you can't do the equity section. Your answer should adhere to the requirements for IAS 1. Comparative figures and notes are not required. Right, so let's start here right at the beginning. This has got everything to do with capital, so let's skip that for the moment. We're going to do the PPE note first. And on 1 August 2017, the following shares were in issue, so that's statement of financial position. Great stuff. Number 3. The land and building were revalued for the second time on 31 July 2018. Now, what does that mean? Why the first time, the second time? It means that if it has been revalued for the second time, there was a previous revaluation. There you can see that. Revaluation reserve, 200,000 Rand. So now, and that also means that that revaluation or that revalued amount is already included in that 2.1, oh no, where it is there, in that 1.2 million. Where's land and buildings? Oh, sorry. Here we are now, at that question mark that we have there. So we don't know what it is, but we know that the revaluation reserve must have been included there if it is actually being recorded on the financial statements or on the trial balance. Mr. Moss estimated that the value of land and building had a fair value of 4.6 million as of 31 July 2018. You have to do the PPE note, so you can, in the meantime, insert on your PPE note, right at the beginning, the value of land and buildings being 4.6 million, because that's the closing value. Then they tell you the property was originally purchased for 3.4 million. But last year, which was the first time, obviously if this year is the second time, that the property was revalued. Don't know what that is. The revaluation reserve was 200,000. So the difference between the cost price and the fair value of that property as at that stage was 200,000 Rand. So therefore, if the cost price was 3.4 million, the original cost, what would have been the opening value of your property? 3.4 million plus the 200,000 rand. 3.4 million plus the revaluation of 200,000 rand, which was done last year. So 3.6 million. So we have the opening value now, 3.6 million. We have the closing value now, which is 4.6 million. So what happened in between? There were no purchases or disposal of land. So therefore, the fair value of the property has increased with R1 million in the current year. So revaluation of land, R1 million. Now, I don't want to do too much about the statement of changes in equity at this point of time, but we will have a revaluation reserve. We have the opening balance of 200,000. We have the R1 million reval this year, so the closing balance then 1.2 million. So we can get revaluation reserve, finish and claw out of our lives and make sure that we have taken account of that. Number 4, equipment consists of a photocopy machine. Now let's see where's equipment. I have equipment at cost, 1.2, 1.2, so no change there. No disposals, no additions. Accumulated depreciation at the end of last year, 200,000 rand. Right. The machine was purchased on 1 August 2017. Now 1 August 2017, what was the date of that 200,000 there? Well, it was 31 July 2017, so it's basically 1 August 2017. It was bought 1 August 2015, so that means that that asset was exactly 2 years old. I'm going to write it in here so that you know that. And you see that just by looking at the date, it means that this asset was 2 years old exactly, 24 months. The photocopy machine caused some problems during the current financial year, as the printing quality of the machine deteriorated significantly. Management revisited the original depreciation estimates as a result of it and decided that the equipment will only be used for 50% of its original estimated lifetime and that the estimated 200,000 rand residual value must be changed to 0. The accountant had to calculate the depreciation charge, including the change in estimate, according to the cumulative catch-up method. Equipment is depreciated on the straight line method over its useful life. The accountant did calculate the depreciation correctly, and this was taken into account when the preliminary profit before tax was calculated. So it's already in the books, but we have to disclose it on the IAS 16 note, therefore we have to calculate that. Wear and tear allowance for income tax purposes agrees with accounting treatment of the depreciation on equipment. Now, if we want to work out the current year's depreciation, we know the cumulative catch-up method was applied. And if the cumulative catch-up method was applied, our depreciation charge consists out of 2 components, one being for the catch-up and one being for the actual depreciation for the current year. Now, to work out the original lifetime of the asset, we could have said, well, 1.2 million rand, which is the cost price of the asset, less the estimated residual value of 200,000 rand. That gives us then a depreciable value of R1 million, and we have for 2 years had 200,000 rand in total accumulated depreciation. So it's straight line. It means it was 100,000 rand in 2016 and 100,000 in 2017. Let's have a look. Exactly 2 years. Accumulated depreciation is 200,000 rand. So it means it was 100,000 per annum. How did we calculate that depreciation? Cost price, 1.2 million, less the estimated residual value of 200,000, divided by X equals 100,000. So divided by 100,000 equals 10 years. Now they tell us that the estimated lifetime is exactly equal to 50% of its original estimated lifetime. So therefore our estimated lifetime is no longer 10 years, but only 5 years. So in the old way, we would have written off 100,000 Rand depreciation. Now our new estimate is going to be as follows. We're going to write off exactly accumulated depreciation, 1.2 million, no longer any estimated residual value. Over 5 years, we've said there that the estimated residual value now is 5 years. Not the residual value, the estimated lifetime is 5 years. So 1.2 million divided by 5 years, up to the beginning of the year, 2 years have passed already. So our accumulated depreciation was supposed to be 280,000. So the catch up, we had accumulated depreciation in our books of 200,000. We actually wanted 480,000. So catch up being 280,000. What is our actual depreciation charge for the year? 1.2 million divided by 5 years equals 240,000. So that means we will have total depreciation on equipment this year of 520,000. So equipment, we started off with the 1.2 million and the 200,000, which gave us a carrying value at the beginning of the year for million rand. Current year, we have 520,000 depreciation, which will end up with then, again, with that same 1.2 million cost price, accumulated depreciation is now going to be the 200,000 plus the 520,000, and that will leave us with a carrying value of 480,000 at the end of the year. Then number 5. On 1 October 2017, a delivery vehicle with the original cost price of 500,000 and an accumulated depreciation of 200,000 as at 1 August 2017, the beginning of the financial year, was sold. The accountant, when did we sell it? On the 1st of October. Did we use it in the current year? Yes, August, September, 2 months, we have used that asset. The accountant wasn't sure how the transaction should be treated and only debited the bank account and credited delivery vehicles at cost with the amount that they have received. And there you can see, delivery vehicles at cost has declined with 300,000 Rand. Vehicles are depreciated on the reducing balance method at 20% per annum. No other additions or disposals of vehicles took place during the year. So that 300,000 Rand move on the cost price can only be the proceeds on the sale of the vehicle. And that proceeds, you can see there, must have been 300,000 Rand, the difference between the two. Depreciation was correctly provided for and was taken into account when the preliminary profit before tax was calculated. The wear and tear allowance for income tax purposes agrees with the accounting treatment of depreciation on vehicles. Now again, so there's no difference. So we can take our accounting depreciation for tax purposes, so it will not have an impact on the taxable income figure. Good, let's first then determine how much depreciation was written off for the period that we've used the asset and how much depreciation was written off on the old vehicles that were still lying there after we took out this vehicle, which was sold during the course of the year. The cost price of the vehicle was 500,000, accumulated depreciation up to the beginning of the year 200,000. It gave you a carry value at the beginning of the year 300,000. 20% on the reducing balance, so it's 300,000 times 20% for the 2-month period, which we've used the asset until the date of sale. So the carrying value of the asset at the date of sale, 290,000, and you can go and park it directly on your IAS 16 note. Disposal of assets at carrying value, 290,000 Rand. Then the old vehicles. What is the value of the vehicles which we had in our possession at the beginning of the year, which we have used for the full year? Well, 2.4 million was the cost price originally, and we have sold that vehicle with a cost price of 500,000. So that means that the cost price was 1.9 million. Accumulated depreciation at the beginning of the year was 400,000, and the accumulated depreciation on the vehicle sold at the beginning of the year was 200,000. So the remaining accumulated depreciation, 200,000. The carrying value of this asset at the date of sale then, 1.7 million. Not at the date of sale. At the beginning of the year, the carrying value was 1.7. Our depreciation at 20% of the carrying value equals 340,000 rand. So total depreciation then 10,000 plus 340,000 in total, 350,000. Value on hand at the end of the year, the 1.9 million. So 1.9 million that we've worked with here, 1.9 million. Accumulated depreciation at the end of the year would be that 200 and that 340,000, which gives us 540,000. That brings us back to a carrying value of 1,360,000. Now we're done with the PPE note. Included in operating expenses are a few traffic fines and parking tickets that agents received while visiting clients to the value of 8,500 rand. Now, it is 100% correct that we have deducted those traffic fines for accounting purposes. But for tax purposes, it is not a tax deductible expense, so we have to add it back in our taxable income calculation. Our tax rate for the year is 28%, dividend withholding tax is 20%. And then we have a few share transactions as well, and the dividends. Okay, there is one transaction though that will have an impact on our income tax. Just have a look at the issued shares at the beginning of the year. And we had 800,000 ordinary shares, 500,000 non-cumulative pref shares, and 300,000 convertible non-cumulative pref shares. None of those are compulsory cumulative redeemable pref shares. Although we are authorized to issue 200,000 12% compulsory cumulative redeemable pref shares. When we go to sell our share transactions for the year, on 1 November 2017, all of the 12% compulsory cumulative redeemable pref shares were issued at 5 Rand per share. These shares are all redeemable in 2025. So we have issued then 200,000 shares. Yeah. All the authorized shares, 200,000 shares at 5 Rand a share, which then gives us R1 million. So our interest is going to be based on R1 million multiplied by 12% multiplied by 8 months for the year. So let's have a look. Interest, 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 interest. R1 million times 12% for 9 months of the year. Did I say 9 months? It's November, December. When were they issued? They were issued on 1 November. So it's November, December, and our year end is 31 July. So it's 7 months. 7 plus 2 equals 9 months. So it's R1 million times 12% times 9 months. And that gives us 90,000 rand. The question also told us with this vehicle story that we have sold that no additions to disposal depreciation was correctly provided for. But clearly we haven't accounted for the profit on the sale or the loss on the sale of that vehicle because the proceeds are still lying in the cost account. So if the proceeds were still lying in the cost account, then we couldn't have accounted for the profit or the loss on the sale of the vehicle. So 2.4 less 2.1, and then clearly you can see that it was only the proceeds. So the cost price isn't out, and then you don't know what happened to accumulated depreciation, but the cost isn't out, the accumulated depreciation is not out, and the proceeds are still lying there. then it means that the profit or the loss on the sale of this vehicle has not yet been taken into consideration. So if we go back to the vehicle then, a vehicle had a cost price 500,000, accumulated depreciation up to the beginning of the year of 200,000. We have worked out the current year's depreciation is 10,000. We have worked out that the carry value of the asset at the date of sale was 290,000, which we actually plotted into the IAS 16 note. The proceeds was the difference in the cost prices of the vehicles between the 2 years, which is 300,000. So clearly we made a profit on the sale of the vehicle of 10,000 Rand. And that hasn't been taken into consideration anywhere. So the profit on the sale, 10,000 Rand. So our final profit before tax was 5,420. Now the only thing that caused a difference between the accounting profit and taxable income was the fines. If you can remember here, they've told us that there were traffic fines of 8,500 Rand included in operating expenses. So for taxable income calculation purposes, we're going to start with our profit before tax, 5,420. We're going to add back the traffic fines of 8,500. We're going to derive at our taxable income of 5,428,500. We're going to calculate 28% tax on our taxable income, and we're going to get our tax liability and tax charge for the year. 1519980. We're going to take that figure and we're going to put it back in the income statement. 1519980, and we're going to derive at profit after tax for the year 3,900,020. And once you have calculated, go and park it under retained earnings, total comprehensive income 3,900,020. Then I think we are fairly done with our income statement, so we can carry on with our share transactions. In the beginning of the year, we had 800,000 ordinary shares of R2.50 each, 2 million Rand. At the beginning of the year, we had 500,000 5% non-cumulative shares at 3 Rand each. So we can go and park it, 500,000 times 3. And also at the beginning of the year, we had 300,000 6% convertible shares at R1.50 each. 300,000 times R1.50, which gives us 450,000. That opening balance of retained earnings, that was in our trial balance, so it is retained earnings, 600,000 Rand. Good, and then we go to the share transactions for the year. We've already done the first one. On 1 December 2017, 100,000 ordinary shares were bought back from the shareholders at a price of 3 Rand per share. Now, if you go to your statement of changes in equity, you see there that we had an issue 800,000 at 2.50 Rand a share. We are going to buy back 100,000 of that 800,000 shares. Not at 2.50 Rand, but at 3 Rand a share. What is the maximum that we can take out of the capital account? Guys, we cannot take out 3 Rand out of the capital account. We can only take out 100,000 shares at 2.50 Rand because that is all that's lying there for those shareholders in the capital account, which gives us then 250,000. Now, our retained earnings is going to be able to fund that additional 50 cents per share. So the 100,000 shares that we're going to buy back at the premium of 50 cents a share, and that premium will come out of retained earnings. What is going to be our accounting entry? Our accounting entry is going to be debit ordinary share capital, 250,000, debit retained earnings, 50,000, credit bank, 300,000 Rand, which will equal 100,000 times 3 Rand per share. Then on 30 April 2018, FNS converted 100,000 of the 6% convertible pref shares into ordinary no par value shares at a conversion price of 4 Rand per share. Now, the first thing that we have to do is we're going to convert 100,000 of those shares. There's our 6%. We had 300,000, so 100,000, exactly a third of that amount is going to be converted. So that gives us 150,000. When we convert one class of share in another class of share, we just move equity around. So we take 150,000 out of this type of capital and we're going to insert it into that type of capital. 150,000 out and 150,000 in. What was the conversion price? 4 Rand per share. So if the proceeds was 150,000 and the price per share was 4 Rand, it means that the company had issued 37,500 ordinary shares to make up for that 150,000 loss of pref share capital. On 31 July, FNS declared a final ordinary dividend of 50 cents per share for shareholders registered on 31 July. The dividend is payable on 1 September. It doesn't matter, dividend declaration took place, so we have to account for it. And the fact that an ordinary dividend was declared means by implication that my cumulative dividends was also declared. So let's do the ordinary one first. We had 800,000, we bought back 100,000, so we had 700,000 left, and then we issued 37,500. So in total, net 737,500 multiplied by 50 cents a share gives us an ordinary share dividend of 368,750. Now, if you go here, the 5% cumulative shares, that's been issued for the full year. So 1.5 million multiplied by 5% gives us 75,000 Rand. The 6% cumulative pref shares, now the 450,000 was in issue up to 30 April, that gives us 9 months. So 450,000 times 6% times 9 months gives us 20,250. And then we had left 300,000 times 6% for the remaining 3 months of the year gives us 4,500. Total dividends then, 468,500, which will then be accounted for against retained earnings, 468,500.